Welcome to CurrencyCast. How do global companies tackle currency management in this age of heightened uncertainty? And how does the carry trade impact currency hedging? Welcome to CurrencyCast. My name is Austin McKinley. I'm the Senior Financial Writer at Cantox and your host. In this episode, we have the pleasure to welcome Daisy Andrew, Interest Rate and FX Corporate Sales at BNP Paribas in London. Daisy, a very warm welcome to you, and thank you for joining us in this episode of CurrencyCast.
Thank you for having me.
Can you introduce yourself to our audience?
Of course. So my name is Daisy Andrew. I work within the IRFX Corporate Sales team here at BNP Paribas. Essentially, this means that I cover large and mid-cap corporates, UK specifically, supporting both their foreign exchange and interest rate hedging requirements. As a team, we're sector agnostic, so I work within a range of industries, each with slightly different hedging requirements and needs, which keeps things interesting for me.
Right.
I've been in this role for about 2 years, but I've actually been at the bank for over 8 years. I joined straight from university. So prior to joining sales, I spent 5.5 years on the trading side, both in FX spot trading and FX swap trading, which I personally feel allows me to have a slightly more in-depth kind of take on the hedging process that corporates and clients across the board should be looking at.
Right, and we're going to take advantage of your expertise in this area, of course, during this conversation. Now let's start straight with the foreign exchange risk management topic. And my first question is about the goals or the primary objectives of CFOs and treasurers as they approach you at the interest rate and foreign exchange desk there in London. Is their main goal to remove, for example, the accounting impact of foreign exchange gains and losses from the P&L? Is it to lower the variability of cash flows over time? Tell us about how CFOs and treasurers express their management goals.
Sure. So in theory, yes, the goal in most cases is to minimize the impact of FX market fluctuations. But depending on the currency exposure, the investment structure of the corporate, the industry, etc., the KPIs can vary quite significantly company to company. So in order to manage this, most companies have a fairly comprehensive and robust hedging policy, which they stick to quite diligently. I think this is the main issue kind of arising from this, or one of the main issues that we see is often these hedging policies are quite rigid and they lack the flexibility to allow treasury teams to update and change the policy and make sure that it's fit for purpose. So as the market evolves, we do see the kind of hedging needs change. For example, what someone did 5-10 years ago is kind of very different to what someone should be doing now, given how the market has changed. For example, if you had a very specific fixed float mix or hedging tenor choice or product suite 10 years ago, there's a good chance that they're not really working for you in the exact same way now. So I think one of the things that I would consider for corporates is to just keep in mind a level of flexibility in your policy. So whatever it is you're trying to do, and as I said, it's generally minimizing the impact of FX market moves. Just make sure that your policy allows you to adjust the way that you're hedging to make sure that you are actually doing this year on year.
Right, and also I think we could argue that changes in the business model and even in technology might affect the goals and how you would go about and hedging. So that's why you require that flexibility. That's a really interesting point. Now there's lots of academic papers and papers from central banks discussing the impact of foreign exchange changes in pricing policies of companies. I've seen recently a paper by the Swedish central bank saying that, arguing that changes, for example, in the Swedish krona to the dollar do not really impact pricing policies at Swedish companies because they see it as a sort of a flight to safety, and they are afraid of adjusting their prices if demand is very low. So that's a topic that is obviously of very interesting to us. Describe, Daisy, for us, please, the main hedging programs applied by companies in relation to their pricing policies.
Sure. So I think firstly, it's useful to think about the different types of FX exposures that corporates have. So for the most part, we can split FX exposures into two groups. You have transaction risks, which are the risks associated with making financial transactions between two different jurisdictions with different currencies, and the potential profit or loss resulting from the moves in exchange rate between the kind of time at which this exposure is built to the settlement time. And then we have translation risks, which are essentially associated with the balance sheet reporting of foreign currency assets and the FX exposure resulting from reporting them in your balance sheet in the functional currency. So I think oftentimes when we look at FX hedging, the vast majority of FX hedging that we do is the transaction hedging. And this can be split into two groups again. So we have booked exposure, which pretty much every corporate hedges. That is FX exposure that you have on the book at the time, and then forecasted exposure. And I know you work at Cantox, and a lot of what you do will be working with how to automate and improve this forecasted exposure hedging. So the way that forecasted exposure is hedged varies quite a lot company to company. And this really depends on largely the confidence in their forecast, to be honest with you, but also their capacity to hedge, the ability to absorb market movements, and the kind of list goes on. But often clients use a layered approach. And by this, I mean, they might do 100% of hedging between 0 and 3 months, 75% between 3 and 6 months, and so on. But what we do see is some patterns between different industries. So if you look at pharmaceuticals, for example, they generally hedge quite short dated, so 3 to 6 months, given the fact that they have wide margins and quite a good ability to pass costs through to consumers. Retailers, on the other hand, use a very layered approach, 6 to 18 months generally, and often just with the competitors, because what you don't want is one supermarket having to increase their pricing because they didn't do the forecast hedging well, whilst another one did and therefore doesn't have to increase pricing. And those tight margins mean that consumers are going to pick one supermarket over another. And then if we look at industrials and in automakers, they often hedge much further out, so 2 to 5 years. And again, they have very tight margins, but also a really good ability to forecast their cost base going forward. So it really depends on business model. But again, as I've kind of alluded to before, what I think is important is that Treasury isn't seen as a restrictive function, but it's commercially supportive, i.e., if you need dynamic pricing in one area of the business and stable pricing in another, you have the ability to use that and do that. So a good example would be a kind of holiday company that offers flights through their airline and also holiday bookings. You want the stable pricing for the holiday bookings, so the hotels don't vary day to day, but you need the dynamic pricing in your fuel cost hedging. So it's really about tailoring the way that you hedge and your hedging policy to make sure that it is being commercially supportive.
Yes, absolutely. We agree completely there. Now, you discussed you mentioned the topic of forecast accuracy, right? And so let's dig a little bit deeper into that. Here again, it was obviously a big topic a few years ago with COVID and associated problems there. But there are all the time new developments like nowcasting or even the use of artificial intelligence. I was present at the EACT summit in Brussels back in June, and the audience was mesmerized by a presentation by ASML, the Dutch semiconductor company, saying that the use of an artificial intelligence tool allowed them to improve on their forecast accuracy. So broadly speaking, how do you approach that topic, the topic of long-term cash flow forecast accuracy?
Yeah, so in my experience, it's a huge challenge faced by nearly all corporates, to be honest, and certainly one of the key barriers to kind of moving into automation when it comes to the FX hedging. I very often find myself wishing that we had created a partnership like we have with Cantox with a forecasting startup, because I think that would be a great thing to sell. But it is clearly there's a kind of hole in the market, and most corporates do find it quite challenging. What I will say is generally this lack of ability to accurately forecast their FX exposures means that corporates do seem to avoid wanting to heavily automate their hedging program. And it means largely, I think it's because they want to have this manual oversight. They want to be able to say, hold on, every month we're left-hand side euro dollar, but this price, this exposure is right-hand side. Why is that? Or, this seems very outsized versus the usual. But I do feel that this is a little bit short-sighted, because with the right automation, and certainly conversations that we've had with Cantox, with other clients, we can build in these kind of red flag checkers into the automation. So maybe instead of a person going through and manually checking this every week or month, you have a robot doing it. And that's much better. You don't have that added element of human error. You have these very strict rules where if the notional is above X, or the direction is different to the last 3 months, or whatever, however you want to build it, we can go through and check them every single time in the exact same way, like I say, without that added element of human error. And doing this level of automation and helping that should, in theory, free up time to be able to work on forecasting and make sure that your model is being improved kind of month on month, rather than wasting time manually checking forecasts each time you're looking to do some hedging.
Yes, absolutely. We like to say at Cantox that if you combine a micro hedging program for firm sales orders with a program that hedges the budgeted exposure, you have a sort of a nowcasting tool. And we like to downplay a little bit these concerns that CFOs and treasurers sometimes express when it comes to forecast accuracy. Daisy, let's move to the topic of the carry trade. And I know you were, correct me if I'm wrong, but active in FX trading also at BNP Paribas before. And you remember, of course, what happened in early August 2024. Now, it turns out that I was leisurely traveling up and down the Basque country, both on the French side and on the Spanish side, as I read the news there. And I also happened to come across a paper by the BIS, the Bank for International Settlements, and they wanted to put numbers on the carry trade, especially on the size of that apparently huge short position in Japanese yen, right? And there is no way to really do that except to take what happens in futures markets, where you have observable figures for those positions, and extrapolate them to the over-the-counter markets. And I think they came across with a number of like $250 billion equivalent in short yen positions. Tell us, Daisy, how does the carry trade work?
Sure. So it's actually something interesting. When I joined the corporate desk, I had to kind of rethink the way that I looked at carry, because I do think that corporates and investors do see it slightly differently. So using the yen carry trade as an example, as you've already mentioned, the way that an investor would see it is they would borrow yen to fund buying a higher yielding product. For example, MEX. So you could borrow yen at near 0% and then sell that to buy MEX, and you could buy Mexican bonds or whatever you really wanted. Let's say bonds, for example, yielding around 10%. If you're borrowing at 0 and you're buying something at 10, you're making 10%, which is amazing. the process of doing this requires you to sell yen and buy MEX, so essentially right-hand side MEX yen. This idea is great, and over time you can slowly build this 10% a year or whatever the difference is. And that's fab if your currency doesn't move, because you're just earning this yield and you're not getting the kind of negative effects of currency movements, or if you are in a risk-on environment, for example, it might benefit you. But what we saw over summer was this much loved carry trade, for example, MEX yen, starting to move in a kind of negative way. So we saw yen strengthen and a bit of risk off, and MEX yen over the course of about a month in summer moved over 20%. So very quickly you've completely wiped away your 10% carry benefit, and you're now 10% out of the money in the space of a month. So obviously what this resulted in was a mass kind of exodus of all carry trades, and I remember we saw dollar yen falling around 12.5% over the course of that same month, just as everyone in the market, or not everyone, but a lot of people in the market who had these yen carry trades were just forced to buy back their yen, and it becomes a bit of a snowball effect where it just builds and builds and builds, and as more people buy yen, more people with the carry trade come out of the money, and they are forced to stop out as well. So like I say, bit of a snowball effect, not a very nice moment for many junior traders whose managers had gone on their summer holidays, but an interesting moment regardless.
Well, absolutely, and really great explanation there. Daisy, I have two more questions here regarding the carry trade, but let's start with this one. What techniques can be used in foreign exchange corporate risk management to mitigate the impact of the, say, for example, when you sell in a high discount in a high forward discount currency, or you buy in a forward premium currency? What are the main techniques that you can advise corporates to use?
Carry is always a bit of a difficult topic for corporates, and sometimes the market just isn't working in their favor. So we as a team do have a kind of suite of ways in which we can help them mitigate negative carry costs. So there are a few things that corporates can consider. One is just incorporating some optionality into their hedging portfolio. We've back-tested a range of different structures, and note that in low vol environments, and I know it doesn't feel like it, but we are still in a low FX vol environment. Yeah. Some strategies, such as, say, automated rolling collars, have proven to work really well. And so for corporates who do have the flexibility of incorporating some optionality, it's definitely something to consider. Another alternative, and probably much more in line with Cantox, is really just to hold off hedging when carry costs are high, and then incorporate a range of limit and stop loss orders to ensure that the market doesn't run away too much from you. So I've had a few conversations with corporates and Cantox, and it's something that they can do, incorporate these kind of limit orders into the automated hedging process, and just kind of hold off from hedging currencies with high carry costs. So we did some back testing, or Cantox did some back testing, and you can use a range of max loss scenarios depending on your risk appetite. So maybe you're willing to lose 1 or 2% a month, because that's how it works with the carry. You're already going to be paying, say, 0.5%. You're willing to risk another 0.5%, or however you deem fit. And the back testing does show that for many currencies, this proves beneficial versus just hedging day one. So it's definitely something to consider.
Absolutely, we're very big fans of using automated conditional orders there to delay hedge execution in the face of unfavorable forward points. And by the way, it gives treasurers time also to, coming back to what you said earlier to update their forecasts. In some setups, could even be beneficial from the point of view of collateral management. And why not? You might uncover netting opportunities, right, by delaying hedge execution. Now there's come to the last question on the carry trade, and it has perhaps to do a little bit with our own position, but I would really like to have your views on that. What are the lessons, if any, of that episode of the carry trade, again, early August 2024, for corporate FX managers? Our position is mostly keep calm and automate. But what would you say?
Yeah, so I guess to be honest with you, most corporates kind of were of the same view. The volatility that we saw over summer, especially with the carry washout, it felt really hectic for, say, me or the traders sitting in the seat. But in reality, as I already mentioned, vols do remain relatively low overall. And given the last few years, well, the last 5 or so years, I think we're all pretty used to quite punchy moves in the market. Chatting to corporates, I think the vast majority didn't see the moves as any reason to deviate from their hedging policy. A few saw opportunities to restructure some trades, add or remove optionality, build on carry trades. But like I say, the vast majority were kind of unfazed.
Right.
I think honestly, if you look over the last 5 years, the major events where we saw people actively changing the way that they did things were the pandemic and also Russia. So basically times where we saw huge mark-to-market swings or exposures just ceasing to exist, and them having to try and manage this in incredibly challenging liquidity conditions. Annoyingly, I wasn't on the sales desk, but I think it was maybe more interesting on the trading side, because I joined at a historically low rate, low vol environment back in 2016, and I'd never really seen things move more than a few basis points a day, and that was when something was going crazy. So when COVID hit, we saw these massive moves, and I just think most corporates and investors just really had their hands forced, and they had to act quickly and be assertive with the way that they did things. But I think the lessons that we learned from that and the lessons that we learned from summer is just, again, remain super nimble, very flexible during volatile periods, and not require these crazy market events such as COVID or Russia to trigger you to update your trading pattern. Just be kind of versatile where possible. And I guess, if anything, it might be an interesting time to consider automation, because the last 5 years of data has almost already been stress test. So if you are incorporating 5 years worth of data into your hedging policy and the automation, the automation that uses that hedging policy, in a way it's been stress test, so you know that it's already gone through the ups and downs, and it should prepare that model better for any kind of super volatile periods that come up.
Right. We're also very huge fans of backtesting all of the models all the time, and as you correctly point out, there's lots of data to do that. Daisy, I came across recently with a paper from the Bank of England, and it goes back a little bit to the huge moves in markets that we saw in cable mostly, right? Of course in 2016, but also in September 2022. And in that paper there was the rather surprising conclusion that lots of UK firms, given what had happened to sterling, were starting to invoice directly in US dollars. Do you see that really happening to a significant extent, and how would that affect corporate hedging?
Yeah, so we do see some dollar invoicing, and I guess to an extent it makes sense, because generally dollar is seen as a little bit more of a stable, safer currency than the pound, especially post-Brexit and the like. But I think more so than dollar invoicing, we're seeing corporates shifting away from invoicing in majors, i.e. euro, sterling and dollar, to invoicing in local currency as and where possible. So this allows treasuries to take control of their currency risk and bring it in-house. Obviously, if you if you think of the way that they're invoicing, if they're coming in, if they're invoicing local currencies in dollars or sterling, they're paying possibly quite hefty exchange rates without really noticing. Often this is because corporates don't want to have to manage a huge number of currencies. They're bringing supplies in from many different countries with many different currencies, and it's just too much for a normal treasury team to manage. So they tend to not invoice in local currency and prefer to just pick a major currency. Like you say, dollar might be more stable for some cases, so maybe they would go with that one. But because of this awareness of the additional FX exchange rate that they're being charged, I think the transition is to move back into, or to move towards, local currency invoicing. And that is something where, a tool such as Cantox or this kind of automation process can really help, because it will reduce the workload by increasing the automation, and then therefore you're able to bring more currencies in and hedge more currencies more regularly. And I think that's something that can really shave quite a lot of costs off corporates.
Right, absolutely. Now, Daisy, let's shift the conversation a bit towards the topic of automation and digitization. And so tell us, what is your experience in applying FX automation with your corporate clients?
Sure. So I've worked very closely with Nadia, who works at Cantox, and some of my clients, and one in particular comes up who has signed on to Cantox, which is great. But like many corporates, their hedging process was quite manual and labor intensive. And the transition we see is that treasury teams are getting smaller and smaller. So when you're having to do these very manual labor intensive things, it's within quite a lean team. So this corporate in particular had a large number of subsidiaries, so around 30, and exposures in loads of different currencies. And every month the hedging process involved consolidating 30 spreadsheets with loads of different currencies into one kind of big spreadsheet showing what their exposures were, and then they hedge them, and then they kind of send back those rates to the subs. The spreadsheet had lots of hard coding, manual overrides, and the like, and it was one of those where really there was just one person at the company who knew how to do it very well, which introduces a kind of level of key man risk. But Cantox can do loads of amazing things, but I think the key thing here was just time saving for the company and reducing some of that key man risk. So by automating the data collection and the kind of number crunching, it just frees up the team's time to work on other things, such as, can we find ways to reduce the carry costs? So this company has exposure in high carry currencies, or check that our forecasting is correct, or check that the information we're getting from the subs is correct. And I just think, every month they were spending days going through all of this, and really just the value out of Cantox there was time saving and making everyone's life a little bit easier. I think it's a good example of, I think many corporates I speak to think that Cantox might not be relevant for them because they have quite a basic approach to gathering and editing and converting their exposures into actual trades, and they use spreadsheets and stuff like that. But it's useful to know that even if you don't have a very advanced TMS, there's still a very real role for Cantox to help automate your trading process and save some time.
Right. Daisy, Andrew, interest rate and FX corporate sales at BNP Paribas in London. I think we've covered lots of topics. We started out with general views on currency management and the goals of CFOs and treasurers. We then discussed the carry trade and all of its implications, and we got a really interesting and insightful views there from a person who has worked both in FX trading and now in corporate, so for corporates, right? So, and we want to discuss a little bit the topics also of automation and digitization. So a really interesting conversation. Daisy, is there something that you would like to add?
No, not really. I just think don't be scared of automation. We all use computers and the internet and everything in our day-to-day lives, and it's just another step, I guess, in the road to get where we need to be and to make sure that we are working as efficiently as possible. So it's always worth a conversation.
Right, and now that you say that, I remember that in a previous conversation, we had discussed this issue that some teams that are considering automation are a little bit daunted by the idea of applying automation, right? And so they end up hesitating. How would you go about and solve this type of issues?
Yeah, I do remember one conversation where they were afraid that if they had a very heavily automated hedging process and the person who historically had been doing the dealing for, say, the last 10, 20 years and knew how to do it manually left, then the new people who came in this world of heavily automated hedging might not know how to do the manual hedging. And if the system breaks, which we're always aware that there's a chance that might happen, how well equipped are they going to be to manually hedge their exposures or work it out themselves? And it's the same issue that we face in our team. Many clients do all their hedging over the platform and it's all pretty automatic. But we still need to be aware of how to do the manual trades and how to build them and execute them and book them and that kind of thing. So it's just important that we do make sure that all the juniors coming through are trained kind of to be able to do that if the need be. I just think that is a kind of it's the path that we take. We lose some skills, of course, but we just need to make sure that we're making sure that juniors and the new people coming in do still have that manual execution understanding and they know how it works. And I guess a way that, say, CanTalks, for example, can alleviate those fears are by making sure that you are very comfortable with your CanTalks salesperson, and you do have quarterly updates and training sessions on how to use the software. But on top of that, you stay in touch with your MDPs or whoever you use to trade and your banking partners, and they can also provide the manual hedging training that you need. I get it, it's scary, but it's just something that I think we're all moving towards automation and AI and the like. So I think you're better off just being at the front of that queue and, taking it as it comes rather than stepping back, allowing your business to suffer because you haven't been moving with the times, and kind of make sure that you're right there, minimizing your FX costs from day one.
Absolutely. And remember, we have all the solutions include all the desired manual checkpoints at any time. Daisy, Andrew, again, interest rate and foreign exchange corporate sales at BNP Paribas in London. Thank you very much for joining us in this episode of CurrencyCast, and see you next time.
Thank you for having me.